Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell. Stocks are higher here as investors await Nvidia's earnings. We want to talk about those results, and who better to do that with than our very own Jared Blickery and Dan Howley. Guys, it is great to have you here. Jared, why don't we start with you? Pull up a chart of Nvidia. Let's talk about how Nvidia's been trading heading into this print.
Let's do that. And I got the Wi-Fi interactive right here, so that'll be pretty easy. This is what it's done today. Nice little pop for Nvidia, and I'm going to show you, let's go year to date, because I think this is going to be instructive too. Nvidia was underwater year to date just a few days ago, but it's had a 4-day streak now, and it's kind of taken off a little bit, but I got to show you the last 6 months, because over this time period, it has done basically nothing. And in fact, if I go to 1 year, you can really see it has just been sideways, sideways, sideways. Now it's kind of broken to the upside there, but we got these record highs from, what is that, last October, early November in there. And so it's going to take a little bit. It's going to take a catalyst. Fortunately, we have a catalyst that might be upcoming here. But I think gone are the days when we're going to get those 50, 100% pops in the ensuing weeks after a report like this. That's just an opinion, but I got a little bit of history to back that up too, we can get to in a minute. But before I go here, I just want to show you what's happened over the same period with the semiconductor ETF. This is the stocks over the last year. From those scary April lows last year, post-Liberation Day, it is up 71%, almost 72 over this time frame, and there's not a lot of volatility in there, and that's despite Nvidia really not participating. Taiwan Semi has helped it out, and some of the smaller names have really stepped up, like Western Digital and also SanDisk and a bunch of others as well. Now here's XLK, and XLK, that is a large cap technology sector ETF. This is going sideways too, so this looks a lot like the NASDAQ actually. So Nvidia could be a linchpin here. It could be the catalyst that not only propels the tech sector, but also the NASDAQ, also the S&P 500 to record highs in a few days. But any big disappointment could also do kind of the opposite there.
All right, Dan, turn to you. What do you, my friend, expect to hear from Nvidia? What are the metrics, the data points you make a beeline for?
Yeah, I mean, obviously data center right out of the gate, right? That is, I mean, it's their bread and butter now. It used to be a gaming company. It is no longer a gaming company. You can call them a chip company. They call themselves a platform company.
In the old days, gaming and crypto?
Gaming and crypto, right. Yeah. And I don't think they ever wanted crypto because they were like, well, we don't know how long this is going to last. So no, they were just like, let's kind of ease off on that. Let's go back to where we know that we're going to make sales. But it is interesting, just that Jared was saying, the stock was trading, and you look at how AMD has done in the same period and how Intel has done year to date, which is just wild. And, Intel had an incredibly disappointing outlook. And so, just to see that comparison where, NVIDIA has been coming out with solid news for the last few months, and still it's been kind of range bound in that area. And so, I do think that the big deal obviously is going to be data center and outlook for data center. We want to know what's going on with sales. Jensen Huang has said that the Vera Rubin and the Blackwell Ultra have already been spoken for through 2026. There's customers who already have signed up and are expecting delivery at some point. I think it's also worth pointing out that they've begun to kind of spread themselves, right? Not necessarily too thin or anything, but take into account their networking business. That's a huge part. That's part of the data center line. You'll see compute, and then you'll see networking. That brings in a chunk of change, because if there's a data center that doesn't necessarily want to use all of their components, uses their chips, maybe others don't necessarily want to use NVIDIA's networking, but NVIDIA has solid networking, and so a lot of people will just say, toss it on in there, why not? And then the other thing that they may soon be accounting for is where their CPUs fit in, because CPUs are already a portion of the compute. It's when they sell a super chip, it's 2 GPUs and a CPU locked in together. But they just had an announcement with Meta last week where Meta is going to buy CPU-only servers, so no GPUs as a part of that. So at some point you have to wonder, okay, is that going to be a pattern where they start to sell these CPU servers? It's all part of the kind of evolution of where we're seeing AI right now. And so that could be something to continue to look for, but GPUs are going to be still the biggest seller for them, especially when it comes to margin size.
When Jared brings up the point that you pull up a chart, and for the last 6 months, this thing's done basically nothing. I've heard different theories of why it's done basically. Some people say, you know what, it's maybe investors getting a little cautious because of increasing competition. I've heard other people say, you know what it is? It's that all the good news for at least 2026 has now been priced in. So Jensen better start giving us something on 27. But what do you think? What are some reasons for that?
I think it's column A, column B, right? It's, there's been so much news. What more can we kind of talk about, right? Unless it's, as Jared said, earnings could be the catalyst that does that, right? If the outlook is great, if the sales are great for this, the prior quarter. I do think some of it is fear over competition, whether that's AMD, their announcement yesterday. This wouldn't take into account what's been going on with the stock, but it leads into that idea of competition where they are now going to be launching their own rack scale server. They had announced that at CES with Meta. And so that's a big deal because it means now they're playing in the exact same space that Nvidia plays in when it comes to the data center, right? They can dump in these gigantic, 1-ton machines and just companies can go to town on them, right? The other thing is the continued conversation of, well, is Google going to start eating their lunch because of their TPUs? There was that talk of Meta maybe using their TPUs. Is Amazon going to rent out? They already rent out to Anthropic. Both of those companies rent out to Anthropic. What does that mean? I think, for the large part, any analyst that I've spoken to have said, look, there's two different kind of components here. There's the fact that GPUs are general purpose. So they're going to be able to exist in multiple scenarios where you need them to run this model or that model, whether that's a language model, a video model, or even in robotics, right? So they can go between these worlds. And so that's what makes them so valuable. The other thing is companies may not necessarily want to use Google's chips, right? I mean, they're on their 7th generation. They're sure they're great, but I think it comes down to, do you want to just get the most powerful, or do you want to get what's available? And so, there's the conversation. I think really comes down to the reality of it is there's a bottleneck. So many people are trying to get these chips. How can you get them the fastest? And that may be going with a Google. I think it's also it's the same thing that happened with cloud originally, right? Where everyone was all in on Amazon. Amazon's the granddaddy of cloud, right? And then Microsoft came in, and now Google. And everyone's like, whoa, Amazon, they're done for in the cloud. And it's like, no, people just want to spread out. They don't want to be reliant on one single vendor. And so that's what we're seeing here. I still think that just as Amazon still dominates the cloud, Nvidia will continue to dominate in the GPU space. It just means that there's going to be, some company for them.
Jared, we'll end here with you as we wait for this big report, my friend. Historically, how has Nvidia been trading around these earnings prints?
I was looking at the last 10 reports specifically, so that's 2.5 years worth, and it's split down the middle in terms of wins and losses. Average win was 6%, and there are 5 of them, and 5 losses. The average loss was 4%. And we got this great chart here, so thanks for showing that. This shows you, and this is a separate study, this goes back 10 years or 40 reports, and this tells you, okay, if I bought right before earnings and I held for 1 day or 1 week, 1 month, 1 quarter, 1 year, how much would I make after this specific holding time, on that specific holding time? So going back 10 years, if I only hold for 1 day, because the wins kind of offset the losses there, I only make 1%. 1 week, I only make 4%. 1 month out, I only make 1%. But when you hold for a quarter, things get interesting because then suddenly you're making a 14% median return. And if you hold for 1 year, you're making 93%. And there's no guarantee that this is going to continue, but I think it emphasizes that Nvidia is probably, unless you're a very nimble day trader or swing trader, probably a better play for buy and hold than some of these other strategies. If you're just aiming for the pop, whatever, you could miss out there. So I've looked at a number of different time frames, and it's just kind of suggests to me, and this is a lot of other stocks are in the same category there, it can be treacherous if you try to jump in and jump out.
All right, big print coming up. Thank you guys, appreciate it. Well, let's continue the conversations around NVIDIA's earnings with Alan Bond, Managing Director and Portfolio Manager at Jensen Investment Management. Alan, it's good to see you. So on this NVIDIA print, Alan, what are you expecting to hear? I mean, it should be, Alan, you would think pretty good news, right? Given what we've heard from Taiwan Semi and the hyperscalers.
Yeah, no, I agree. We know there's demand for chips, and as you were talking about on your last segment here, the big question is there a shift in the demand, right? We look at NVIDIA as an incredibly well-placed business. They continue to make chips that are faster, more powerful, more power efficient. There's increasing software attachment to those chips. We think that makes the business better. It makes it more sticky. But we've also seen a trend where data centers are diversifying their chip makers. And so we're seeing different types of chips being used for different needs. And the big question that we'll hope to get answers to during the earnings call is NVIDIA keeping, gaining, losing market share, and what's happening relative to this overall demand?
One trend more broadly, Alan, you point out here, you say the market has entered what you call here a show me phase for AI. What does that mean exactly, Alan? Is it revenue growth? Is it it's free cash flow? It's ROI? Like what are the metrics investors then would be focused on?
Yeah, well, the AI trade, so to speak, for the past 2 or 3 years has really been kind of a build it and they will come mentality, meaning that we know that AI is going to require a lot of computing power and a lot of data center capacity, and there's insatiable demand for that right now. And so, if go back to a year ago, CapEx announcements were greeted with fanfare. What we've seen in the last 6 months is a bit of a subtle change there, where now investors are scrutinizing the returns on those investments, and how can we monetize those investments in data center spending and chip purchases and all the other things that we've talked about. And we're also seeing a big shift towards application of AI, and that's really been the theme so far in 2026 is agentic AI and AI products that are going to potentially be able to displace existing software products and how those two things will work together. And so that's really the show me phase of the AI story that we're focused on right now.
What if, Alan, AI monetization ultimately isn't as strong as maybe a lot of optimists would have expected? I'm just curious, one, how much of a risk do you think that is? And two, if it is a risk, where might it show up, Alan? Like, do you think, okay, I would see that in the hyperscalers or AI hardware or maybe AI software?
Yeah, that's a great question, and it's really hard to say there's any indication that that's happening right in the here and now. But I think if you're to look at that, it's going to be demand for chips. We know that space has historically been very volatile. Trying to predict demand for computer chips for any time period is really difficult. There's a lot of uncertainty. That's probably where we would first see weakness. One of the things that we're going to focus on here during earnings season, or we have, but we'll continue to focus on, is on pricing power among the data centers. One of the things that we've been hearing a lot about is that the data center capacity is scarce. Demand exceeds supply. And so what does that mean for pricing power for the data centers? And that's one thing that we've had a lot of conversations about internally.
Alan, you talk also about how the AI opportunity moving beyond the obvious winners, you say, so into other players. What other sectors broadly would you see that, Alan? Is it moving, is it memory? Is it storage? Power infrastructure?
Yeah, well, we've definitely seen a big surge in memory chip stocks to start the year, and we're seeing evidence of extreme price increases in that space, and those stocks have responded really favorably to that. That's one area. The one that, if you look at our portfolio where we have exposure, is on the hardware side. One of our top holdings is KLA Corporation. They make process control equipment for semiconductor manufacturing, and it's really kind of agnostic to the type of semiconductors. It's just their content is mission critical. Taiwan Semiconductor is a big customer, for example. And again, the one clear trend that we're still following is that more compute is needed. And there's still some questions about directionality of, is that GPU compute, is that CPU compute, is that for model training, is that for inference? But the reality is more compute is needed. More compute means more semiconductors, and that means more demand for semiconductor equipment and process control and mission critical equipment and so forth.
Final question. You say here you're screening for what you call quality growth right now. What does that just walk me, what does that actually mean in practical terms, Alan? And then are there certain sectors which are screening well for that?
Yeah, so the way we think about quality growth is we are looking to invest in businesses that we believe will grow and create business value sustainably over time. So we focus on business factors, businesses with competitive advantages, strong balance sheets and free cash flow, and attractive growth prospects. And we think that checks the quality box, but it also is the formula we believe for sustainable value creation over time. So we look for businesses that have maintained that equation consistently over history and only invest in those businesses. So that's how we think about that. Now, in terms of where that ends up, where our exposure ends up as a result of that, we do see a lot of technology businesses that check those boxes right now. We think there's a lot of value creation that's happened in technology. There's select opportunities in healthcare and industrials, where we think there are niches that businesses have been able to carve out and create that value. The areas where we don't have a lot of exposure, we don't see those opportunities, is in more commodity-focused sectors like in energy, or a regulated focus sector like utilities, or kind of a mature sector like mature telecom. So that's where we have lower exposure, but higher exposure is going to be tech, communications, healthcare, and certain industrial businesses as well.
Alan, so good to have you on the show today. Thanks for your time.
Yep, thank you very much.
Coming up, Richmond Fed President Tom Barkin talks the outlook for rate cuts. That's next. Markets are digesting trade talk and President Trump's State of the Union address. Richmond Fed President Tom Barkin sat down with Yahoo Finance's Jennifer Schonberger to talk about the job market, inflation, and navigating the tariff fog.
Well, I do think businesses have been talking about this fog thing for a year, and it's policy uncertainty, it's geopolitical uncertainty, it's also AI and the effects of AI. And so there's a lot going on in the minds of businesses. And I think it'd be fair to say that, the back and forth on tariffs over the last week just adds to that. So I do think the businesses still feel that heightened uncertainty, and that has something to do with why you see such a low hire rate, and something about why people aren't leaning into investments the way they might. We are seeing, though, across the data and across the economy, a lot of resilience despite that fog. And we've seen the recent unemployment numbers. Demand remains quite healthy, and so despite all this fog, I still think you see resilience. And that's what I was commenting on when I was saying, it's coming a little bit more into focus. People are learning to live with the uncertainty.
To your point, you said in your remarks that businesses are learning to live with this uncertainty, but you said hiring remains low. So what is your outlook for the job market? We had a strong January jobs report, but in light of this renewed uncertainty with tariffs, businesses learning to live with that. How does that inform your outlook? Do you think that we are seeing stabilization, or is there a sign with the January jobs report for a renewed increase in hiring, perhaps?
What we hear from the businesses we talk to is that the demand side of the job market is still, it's still loose. There is still uncertainty. In that uncertainty, people are firing, but they're not hiring. They're not leaning into it. And I haven't heard a lot of stories of people leaning into hiring. The unknown is the supply side of the job market. And obviously, we had significant pullback in the growth of labor supply over the last year, immigration being part of that. And that drop in job growth and the drop in labor supply growth have been about the same amount. That's why the unemployment rate stayed relatively stable. Hard to know where that's going from here. But I'm not seeing a big pickup on the job growth side. But we're continuing to see, it in relative balance, I think, because of the drop in labor supply growth.
And so you expect that to continue?
We'll see.
In terms of the impact of artificial intelligence on the job market, we've heard some comments from Anthropic's CEO that it could lead to layoffs of white-collar workers. There's a new report out that is going viral that says that AI could slash white-collar jobs as well, leading to mass layoffs and a recession. What are your thoughts on that?
Well, the potential of AI, I think, is significant. And there's certainly places like coding and call centers, collections, where you're seeing it being rolled out and that affecting the labor job growth. It doesn't seem to have yet affected broadly, but of course the potential's there. There's also the potential to enable people into jobs. We've talked to some manufacturing people who say, I'm having trouble finding workers, but I think if I can leverage AI, I can spool up a bunch of other people who would not necessarily be ready for the job market into this job market. So it's got potential on the other side too. The human nature is not to focus on the upside, but largely the downside. However this plays out, I think the question is not whether we'll have jobs eliminated or jobs created. is what will the redeployment process look like? How fast will it happen? And how much downside is there in the labor market while you're transitioning from the old jobs into the new jobs? And we'll just have to see how that plays out.
Let's talk about inflation. Sitting at 3% on a core basis, excluding those volatile food and energy prices, is measured by the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index. The Consumer Price Index looks a little bit better, 2.5%. Some are saying if the effective tariff rate under the new tariffs, now that IEEPA has been struck down, is a little bit lower, that could help inflation. What's your sense when you look at goods prices, services prices, housing prices, of whether you could see inflation start to drop later this year to the point where you felt it was on a sustainable path back down to 2%?
Well, so when we're talking to businesses, most of them, especially in the business to consumer space, feel like they're about done with price increases. Consumers have pushed back. They're trading down to private label. They're going to discount retailers. You hear that constantly. And I just think you've got a consumer that's exhausted with price increases and just not going to take it anymore. There's a little more pricing power in the B2B space, but in the B2C space, I think most people feel like that's kind of run its course. And so that makes me cautiously optimistic that, inflation will continue to come down. On the other hand, inflation is 3%, as you said, and it's been about the same for the last year. And frankly, it's been over our target for 5 years. And I do think, as I said in my talk today, that sustained inflation over target does bleed into pricing decisions that businesses take. Because as you're trying to set your prices for the next year, a critical reference point is what's inflation. And so sustained high inflation can lead to more inflation. And so that's what I worry about. So I'm hopeful that inflation is going to come down, and I can see it in some of the behaviors and dynamics. I'm very happy that my salty snacks prices are going down. But, I want to see it.
But what about the tariffs? How does that tie in?
Well, we'll see how the tariff situation plays out, both in terms of the rates that are applied and whether there are refunds. What I'm understanding is that overall, the tariff rate ought to be somewhere in the range of where it is today. And if that's the objective of the administration, then I don't think in aggregate you're going to see a lot of differences. You'll see differences commodity to commodity or geography to geography, but not in total. I'm assuming there'll be refunds. If there are refunds, that'll create some potential for price reduction. But remember, it's hitting the importers, not the final retailers. And so I sort of see it like a corporate tax cut. That money goes into the system, and all the people in the supply chain that bargain about who gets the money, and maybe some of it will go to the consumer, but a lot more of it will go to the people in the chain.
You did 3 insurance rate cuts at the tail end of 2025. Policy in a good place now?
Well, I think we took out a little bit of insurance to make sure that the labor market stayed stable. I've been reassured by what we've seen in the labor market the last couple readings. I hope it continues.
How close are you to neutral at this point?
We'll see. Neutral is this unicorn that's alone in a forest that no one's ever seen. And so you sort of try to figure it out as you go. I've been reassured by the labor market, as I said, also by the demand side, which has stayed relatively healthy. And I think that's the question, is whether you need to put more in there on the rate side to help bolster demand. We'll learn more about that as the year goes on. JP
Morgan CEO Jamie Dimon said earlier this week that the financial world looks very similar to how it looked pre-financial crisis, 2005, 2006, 2007. At the same time, we've seen some issues, if you will, in the private credit market, a lot of redemptions with Blue Owl. And Treasury Secretary Scott Bessent says he has some concerns. What's your take on this? Do things look like 2007?
I certainly hope not. On the positive side, bank leverage far lower than it was in 2007. Personal leverage far lower than it was in 2007. Corporate leverage around the same, maybe even a little better in the last 2 or 3 years. And so the leverage doesn't seem to be as much. But of course, the question is always, what do you not know? And what leverage do you not see? And we don't see the leverage off, outside of the banking system nearly as well as we see it within the banking system.
Let's get some reaction now from that interview with the Richmond Fed President. David Seif joins me in studio. He is, of course, Nomura's chief economist. David, always good to see you. So let's see what Mr. Barkin had to tell us here. So cautiously optimistic inflation will continue coming down this year. Reassured by the past few jobs reports, did question more cuts. Here was the line. He says, I've been reassured by the labor market, also by the demand side, which has stayed relatively healthy. He says, I think that's the question, is whether you need to put more in there on the rate side to help bolster demand. What do you make of that, David?
Well, I think first of all, great to be here. I think this is still a Fed that by and large has an easing bias in there. And although they've toned that down a little bit after the 75 bips of cuts in the past few months, that still seems to be the direction that they're going. Now, at Nomura, we have a relatively optimistic view on the economy right now. We've seen a pretty blockbuster jobs report came out for January, but more than that, we think that it's really part of a trend of a recovery in the labor market. And so, what we're ending up left with is a pretty strong situation for GDP. Certainly has done much better since Liberation Day than virtually any pundit had expected. We have a labor market that, although it's lost some momentum, appears to be bouncing back and really never got that bad. And then on the other side, we have inflation that looks like it's going to miss to the upside from the Fed's target for a sixth year in a row. And so the Fed may be a little bit dovish. It's not really clear that the data bears out the need to cut rates further at this point.
Switching gears, President Trump's State of the Union. You make a point here, David. You say it looks to you like Trump now faces the same kind of affordability problem that impacted Biden. I guess two questions there. One, what is that problem? How do you define it? And two, is there some kind of policy fix for it?
Yeah, I think that the short answer is that the policy fix may be worse than the problem, or the medicine may be worse than the disease, so to speak. There was a very big burst of inflation, as we all know, post-COVID. That didn't really happen under President Trump's watch, but it doesn't really matter. And I think somewhat the disconnect that people have is they recognize correctly that prices are much higher than they were in 2020. But the expectation is that inflation ending means prices go back to where they were. And that's not the case. They just don't go up anymore, or they don't go up as quickly anymore. And that's what inflation getting back to target is. So this is something that has really hurt politicians on both the left and the right in the United States and elsewhere. And there is a certain amount of being wrong place, wrong time for any politician in power right now, where the public is still getting used to the fact that prices are much higher than they were and aren't really going back. I think in terms of solutions, the best thing to do is to allow the Fed to bring inflation back under control. They've certainly gotten most of the way there. And to avoid doing things like additional stimulus to an economy that is still relatively hot, such that we could get inflation. I think that's really a lot of what led to the post-COVID inflation, overstimulating the economy in a way that it just really couldn't take.
Another big topic, Supreme Court weighs in. They strike down Trump's IPO tariffs. You say that wasn't such a big deal. Now, do you say that, David, because you look at Trump and say, listen, he's just going to pull other levers?
Yeah, exactly. I think this is a matter of where Trump may have lost this battle, but he's probably going to win the war when it comes to tariffs. There are at least 6 powers that Congress has given the president to impose tariffs. And the Supreme Court effectively struck down one of those. Now, it does happen to be the one that President Trump has used, but you've seen already, as of yesterday, we already had a different power, Section 122 they're called, putting in place what I think is somewhat of a placeholder 10% universal tariff that really replicates not the detail or the nuances of the tariffs, but the bulk of the tariffs there. That can last for up to 5 months. And in the meantime, President Trump can start to do or have initiated some of the investigations that are necessary in order to impose tariffs on other countries, much as he did on China in his first term. And once those are in place, the president will be able likely to replicate virtually all, if not all, of the tariffs that the Supreme Court was struck down. And we would expect that to be in place by about mid-year. So it's really it's really just a bit of a bump in the road. It's not as though the tariffs aren't going to be able to be in place going forward. Final
question, Dave. I think this was interesting, because Trump has made it clear, like, Kevin Warsh, that's his guy. That's who he wants running the Fed. You say Warsh is potentially more dovish than the market expects. Now, that's interesting. I guess, why do you think, David, maybe the market is kind of broadly misreading Mr. Warsh? And then two, if you're right, what are potential implications, ripple effects, Dave, of that for investors in terms of dollar long-term yields? How do you think through it?
Yeah, I mean, I think this is going to be, especially as we get to the second half of the year and Warsh is Fed chair, I think this is going to be perhaps the most interesting theme economically in the second half of this year. We should remember that a lot of the statements that Warsh has made that people have said are hawkish were made either a really long time ago or in what I would call a semi-political context when Democrats were in power. And so I think it's really important to understand the context in which they were intended. It would be very, very surprising if after Secretary Bessent and President Trump interviewed Warsh multiple times, that they picked a hawk when President Trump is so clearly hoping to have interest rates lower. And so that's really where we see things going, whether the economy it's the right move for the economy or not.
David, it is always so good to have you here on the show, especially on set. Thank you.
My pleasure.
Coming up, we look at options trades in the software sector. Now time for some of today's trending tickers. Yahoo Finance senior reporter Brooke DePalma is with me here. We're looking at DoorDash, Diageo, and CAVA. Starting with DoorDash, the food delivery company is mixing up its overseas strategy. DoorDash is pulling out of 4 countries in Asia. That move puts more focus on fierce competition in the sectors. Companies operate with, of course, razor-thin margins here. This one, so specifically, they're exiting, it sounds like, Qatar, Singapore, Japan, and Uzbekistan, Brooke, across its Deliveroo and Wolt brands. They don't expect, it doesn't sound like, any kind of material impact to the financials.
But this is something that Wall Street has really been focusing on, international growth. And so they've kept a close eye on this and saw the progress. And now the fact that they're reassessing it and, leaving these specific countries, definitely meeting Wall Street's needs and wants and wishes here to really assess that portfolio as they do scale the operations. Also keep in mind, this is coming on the back of DoorDash's earnings just last week, where we did get that outlook for 2026, that adjusted EBITDA coming in a little bit lower than what Wall Street had been predicting.
Yeah. You know what? DoorDash could use a little love. I mean, this stock, yikes. We're in the red over the past 12 months. You're already down about 20% this year, Brooke. Though I should mention, plenty of analysts look at this and they say, you know what, that's an opportunity.
Yeah,
a lot of buys there.
We do have 38 buys on the street, 10 holds, and no sell ratings on DoorDash.
0 sales on this guy.
Yeah, and when you think about the sort of where we have been, though, year to date, keep in mind, as I just said, based upon that response from the outlook that they had put out, we did see a bit of a sell-off just last week.
All right, next up, let's look at Diageo. Those shares, they're sinking after the drinks giant cut its sales guidance. The maker of Guinness and Smirnoff is blaming weaker demand in North America and China markets. So this, when they cut the sales guidance, weakness in the U.S. market, they reduced the dividend. Maker of Guinness, Johnny Walker. Peers I saw also did come under some pressure in today's trade. What do bulls say on a day like this? RBC, now they like this one. They rate this one outperform. They told their clients the focus actually should really be on the new CEO strategy. They said that's what you should be focused on. That's great importance. They say here, we're going to have to wait for later in the summer to get into the meat of Sir Dave's plans for Diageo, they say.
Oh, I like that, Sir Dave. I definitely think, just to take a step back, what he is up against is really the big picture here that has Wall Street sort of worried. I was listening into the investor call this morning and some things that they said. What's happening is the way people are choosing to engage with the category is changing, particularly for younger people. They said they're making choices about where and how they choose to socialize, aka people are drinking less. Gen Z is drinking less. And this comes on the heels not only of that weakening performance in North America for Diageo, but also this note out from Bank of America yesterday, where it said that more and more younger consumers are actually going to the gym and paying for gym memberships than going out and boozing at the bar, or rather, they're going out and boozing and buying out liquor and wine stores. They're still going to the bar somewhat, but maybe not as much as they used to.
All right, finally, How about CAVA? Because that's surging as the fast casual restaurant chain seen an upbeat forecast. The company also saw Q4 sales beat, higher prices, strong performances from its new restaurants contributed to those results. So sales from established restaurants seen expanding 3 to 5% this year, Brooke. Company talking price increases. They're talking about customers choosing more relatively expensive items. Yeah. Reports showing they're picking up market share here, even as rivals like Chipotle struggling.
Yeah, this stock, 17 buys on the street. We have 9 holds and no sells. Also keep in mind, year to date, this stock now up 44%. So quite a significant run year to date. And we did hear from CAVA's CEO to Yahoo Finance. He actually gave us a quote. He said, in a dynamic environment, consumers are gravitating toward brands delivering real value every day. CAVA's disciplined execution, differentiated Mediterranean cuisine, and commitment to hospitality continue to drive strong demand and reinforce the durability of our model. This is something that CEO Brett Schulman has been saying since the company went public back, I believe, in June of 2023, that they continue to have this unique sort of positioning within this market, especially now as consumers are looking at value. They actually even increased their prices in January, and they're still saying that they're able to deliver the best bang for their buck when it comes to what consumers are looking for. That led to strength across income cohorts and also return of young people too.
All right, Brooke DePalma, thank you. Well, investors rotating back into tech as markets look for footing after AI disruption turbulence. Mike Coe, Tidal Financial Group YieldMax strategist, joining us now to discuss the tradable signals in the options pit sponsored by Tasty Trade. Mike, my friend, always good to see you. Maybe it was our bigger picture, Mike, because you can see there has been a lot of institutional hedging demand. Mike, you can see that in the elevated VIX. So it seems like investors quick to hedge, even though just looking at the major indices, we've gone basically nowhere in months. Just curious to get your take on that, Mike. How do you want to play this in the options market?
Well, it's interesting. We've seen a huge rotation. I think the rotation really started quite some time ago. It began in the second half, basically, of last year. If we're looking at tech specifically, when we saw this enormous divergence take place between software and hardware. If you look at the first half of last year, basically those two tracked lockstep together through the end of the second quarter. And then from basically the end of the second quarter through the end of the year, hardware outperformed software by about 17.5%. And as big as that divergence was, it widened much faster this year. We saw the hardware outperforming software by more than 20%. So that means you've got Nvidia basically holding in there. You've got the AMATs and Microns really taking off. We saw a lot of bullish flows in those. But then you have things like Microsoft and AppLovin and Intuit and Adobe that, I don't think there's a fairer way to describe it than just that they've been slayed this year.
You mentioned Nvidia, Mike. Let's take a beat there because obviously that print is coming right after the close. Listen, big report for the AI trade, Mike. For the market, it's the last of the big tech names to report. What do you see in the options market there?
So the options market right now is implying a move of just over 5% after they report. Of course, it is huge when you consider that right now the forecast is that NVIDIA's GDP, their revenues is going to be about 1% of U.S. GDP over the course of the next 12 months, if you can believe that. The scale is almost hard to comprehend. And of course, it's really important when you consider how closely tied it is to so many of the other mega cap companies. 4 of the largest companies basically represent 40% of the revenues. I'm sort of talking about those mama stocks, Microsoft, Meta, Alphabet, and Amazon represent about 40% of NVIDIA's revenues. I think the real question for us at this point isn't whether the numbers are going to be good. We know that they will be, and we know that from the CapEx from the companies I just mentioned. Some of that information we already have at our fingertips. But really the question is whether the really high growth in margins that are anticipated for next year, close to 75% gross margins, more than 50% year-on-year revenue growth, is that really going to continue to hold up? And I think if it does, that might justify some of the bullish flows that we've been seeing in there.
What about, Mike, more broadly, the chip sector? I'm just looking at the SMH here, the ETF that tracks the sector. We're already up, Mike, nearly 20% this year. We're up around 80% over the past 12 months. Your thoughts there?
Yeah, those obviously have been hot sectors. We have actually 2 funds that focus principally on the hardware side. Both Chippy and Soxy are 2 of the funds we have that focus on the semis. And they've obviously been huge performers. I mean, it's almost hard to believe when you take a look at names like Micron Technologies, for example, after the phenomenal year that it had last year, up north of 60 since the beginning of this year. So, one of the things I think that justifies that is that a lot of this trade still does depend on some of those legacy chip makers. That's one part of it. The other was that if you go back about 18, 24 months, many of those companies were actually quite cheap relative to the rest of the market, partially because they're viewed as cyclical and hadn't really gotten attached to this trade as much as I think they have recently.
Finally, Mike, AI disruption fears, front and center, software's in the crosshairs. The IGV, the software ETF, has been shelled. I'm just curious what you see ahead, Mike.
Yeah, as we were just talking about that, I mean, the underperformance this year has been stark. But, what's interesting is that it's one of the best performing sectors today. You take a look at the options flow in IGV, calls significantly above their average volume and significantly outpacing puts. And that's actually true for some of the worst performing single stocks that are a part of that as well. So I'm talking now about names like Intuit and AppLovin, Microsoft actually seeing some bullish flows in there. That stock has been very hard hit this year as well. So, I don't know whether we can really extrapolate from a day or two of relative outperformance, because that's basically all we have is about 2 days of it. But they did seem to catch a bit of a bid this week. Maybe the worst of that is over.
Mike, as always, so good to have you on the show. Thank you.
Thanks.
Coming up, we discuss the private credit market with the CEO of Trinity Capital. That's next on Market Domination. A once hot area of the market, private credit, now making many investors nervous. And my next guest is in the thick of it, running an alternative asset manager. And in the company's latest earnings report, it is showing signs of strength. Joining me now, we got Kyle Brown, Trinity Capital CEO. Kyle, it is good to see you. So let's just dig into this earnings report, Kyle, because it looks like record earnings here, strong growth in 2025. Walk us through the print, Kyle. What are you seeing in the business?
Yeah, we had a great Q4, and really it was just a great wrap to 2025. Earnings were up, NAV increased 33%, AUM grew by 38% year over year, and we did all that growth while maintaining a consistent and growing dividend. So from my seat, there's a lot of noise around private credit generally right now, but not all private credit is made the same, and we really got to see some great benefits last year, and our shareholders were the benefactors of it.
In terms of that noise you referenced there, Kyle, it's private credit and these concerns about private credit funds and their exposure to software names, given the AI disruption fears, Kyle. So when you think about this and you think through it, does it seem fair and reasonable, Kyle? Does it seem overblown? What do you make of it?
Well, listen, with private credit, you saw the last 5 years, 80-90% of all institutional allocations went to really kind of like 12 companies in the upper middle market. They're all chasing the same deals. And as rates have come down and spreads have been compressed, you've seen those returns dwindle, right? And so, I think this is a really interesting time for private credit because you're going to start seeing outliers. You're going to start seeing some firms who focus on underserved, more niche markets, who are generating more alpha returns. You're going to start to see some inflows. So where are there outflows happening across kind of the broader private credit market? There are some, and we're experiencing this right now. We're seeing inflows from groups that are interested in higher returns and more bespoke and interesting segments of the market, like the lower middle market.
I'm just curious, though, Kyle, given that, though, what sort of is your response, your reaction? Because when you hear big names, Jamie Dimon, for example, and you hear them, Kyle, drawing these comparisons to, past financial crises, to 2008, you read those headlines. What do you think?
I think that the market's adjusting and moving quickly. With private credit, it's growing and growing and growing. And it's growing because public markets are shrinking. You have half as many companies as you did 15 years ago that are public. Well, they're private, and the private markets continue to grow as the U.S. economy grows. And so a lot of that is equity, but a lot of that is debt financing as well. And so banks are figuring out where they land in that. And I think with more regulation over the last few years, banks have figured out different ways to participate in private credit. We deal with banks often, and banks are really, I think some banks are shifting to providing back leverage and joint ventures with private credit firms rather than lending directly to a company and maybe generating a little bit higher return. They can work or JV or provide back leverage to private credit lenders with boots on the ground, and they can get more exposure, more diversification with maybe less of a return, but way less risk as well. And so, I think the bigger banks and the JP Morgans of the world, they're fighting a war with private credit, and particularly those in the upper middle market, really. And they're trying to figure out how they compete and where they land in the space right now. So, but like I said, not all private credit is made the same. And it's because it's such a massive market now, it depends on whether you're in the upper middle market, lower middle market, or late stage VC. They're all robust markets now with their different return profiles.
When you think about AI, Kyle, and granted, we're early days here, we're early innings, but ultimately, Kyle, do you think of it like, listen, this is going to be a tailwind. This is a paradigm shift. It's going to unlock new lending opportunities. It'll prove to be more of a tailwind than a risk to private credit.
Yeah, listen, if you think about it, software, it is the application layer where AI is integrated into real workflows, right? It's where end users actually integrate with AI. And you saw it with IBM and COBOL recently, right? Nobody likes to sit in front of the DMV for 2 hours. Nobody likes to sit in front of an agent at the airport or a teller and wonder what in the world they're typing, right? It's because they're working on 50-year-old software. So on the one end, you have this, it's really hard to take incumbency from someone. And so those that are incumbent software services and I have a whole enterprise trained on it, they're probably going to be in a good position to keep that business if they can integrate AI tools into the business. But then it also shows you that needs to be disrupted, right? It should be disrupted, and it deserves to be. And so where we deal with, which is late stage VC and emerging companies in the lower middle market, the opportunity is massive because you are going after these large incumbent software providers and offering new tools that are cheaper, faster, and better. And so when I look at it, and I understand what the fear is about, but incumbency is really important. It's going to be hard to unseat those incumbent software providers, and they just need to upgrade. And those that upgrade with these tools are probably going to do quite well. And those that do not, they're probably going to lose some market share. But where we deal in late stage venture capital into lower middle market, the opportunities are incredible right now. And we don't just focus on the actual software. We're doing the data center, the diesel generators, the GPU financing, the CPU financing. The opportunities are growing right now as a result of this disruption.
Final question, Kyle. Private credit has, of course, grown rapidly. Bloomberg puts a number on it, Kyle. They say this is now a $1.8 trillion market. Do you look at that, Kyle, and say any risk here? The space is getting overcrowded.
Yeah, I think I mentioned it before, but the majority of institutional investors and even retail investors have really gone to a handful of companies. And I think this year in particular, it's going to give a really great opportunity for firms that focus on more niche areas, who are dealing and lending directly to companies to kind of to shine in a unique way. And I think investors are going to see that, and you're going to see some diversification of allocations to a lot of different companies. And so I don't see it slowing down. We continue to see just really great strength in the portfolio. I think when you see portfolio disruptions, revenues declining, then we can start having a discussion around, is there a risk with private credit? But right now, these are mature companies, and the market continues to grow.
Kyle, great to have you on the show today. Appreciate your time.
Thank you for having me.
We're wrapping up today's Market Domination. Don't go anywhere. We've got Salesforce and Nvidia earnings out after the closing bell. Stay tuned for Market Domination Overtime. Hello and welcome to Market Domination Overtime. Stocks closing higher here as investors await earnings from Nvidia. Let's kick it over to Yahoo Finance's Jared Blickery with the latest market moves. Jared.
Thank you, Josh. As we're all sitting on pins and needles here, let's go over what was some broadly bullish action today. Here's the Dow. It was up 300 points, or about 2/3 of 1%. And you can see we finished the day pretty close to the highs, even though we didn't really advance that much over the afternoon. I think investors will take that. Meanwhile, here's a NASDAQ composite up nearly twice as much, 1.26%. It's 1.25%. Also kind of flatlined here, but very close to those highs very close to the highs of the day. And here's the S&P 500, very similar chart, up 0.8%. I do like to show you the small caps as well. They underperformed today. Large caps were doing better for most of the day. And here you see the Russell still up about 0.4%. And let's check in on the final bond market action. Here's the 10-year T-note yield, up 1 basis point to 4.05%. 30-year also up just a little bit, not even 1 basis point, about half of it. So really not too much of a change for the 30-year, closing the day around 4.69%. Meanwhile, U.S. dollar index edge just very slightly lower. This is just a small amount. I do want to check out the volatility of the day, though, because the VIX has caught my eye, and I'm told we have a little bit more time than usual, so I'm going to give you a preview of what I'm going to be talking about with Josh in about 30 minutes. And here we have the VIX. It is down to 18. I'll show you the year to date, because the VIX has been trending up, and while you don't necessarily want to trade off of trend lines using the VIX, I think it's notable that it has dropped some, because it was just hovering around 20. It seemed comfortable there for a while, especially as we had all those AI jitters, and it seems to be moving down now. I'd like to see it move down to maybe 15, 16, which would be more in line with the average that we had last year for big part of the year. Now let's go into some heat maps, and we're going to start with the large cap sectors. And here we go. That was the NASDAQ 100. We'll get back there. Tech leading the day, up 1.9%. Really nice to see tech leading again. Financials, one of the worst performing sectors of the year, did very well today, 1.7%. Those were the only two outperformers of the S&P 500, but we also saw some positive gains from utilities, consumer discretionary, and communication services. What did not do well today? Staples, industrials, real estate, materials, energy, and healthcare almost flatlining there. Let's go back to that NASDAQ 100, which is looking very bullish. Lots of green, a lot of dark green. Netflix is a standout, up about 6%. But in terms of the big ones, Microsoft up 3, Meta up 2, Tesla just short of 2, and then Amazon and Nvidia up about 1. Meanwhile, Apple and Alphabet up less than 1. So let me show you the dichotomy between the software trade and the semiconductor trade. Today, they're looking pretty similar. Not the story of the year, but they're both going up today. So you see a lot of big names there. Thomson Reuters up another 10%. I think it was up a very similar amount yesterday. Datadog up 5, Palantir up 4, Intuit up 6, Salesforce up 3.5. Meanwhile, here are the semiconductors. Not quite as much bullish action, but we still see some outsized winners here. Western Digital up 7.5, Lumentum up 5, ARM up almost 3, Applied Materials up 4.5, and the list goes on. So let's dig into the Dow, and you're actually going to see a decent amount of red right there. That's because a lot of those industrial stocks that the Dow was named after, the Dow Jones Industrial, didn't do so well today. Boeing down 1%, Honeywell down about 0.5%. Meanwhile, in the energy trade, Chevron down about 0.6%. But we did have some positive action from the financials, as I noted, the number 2 best performing sector today. JP Morgan up here, up 2%. So is Goldman Sachs. And healthcare, for that matter, in healthcare, we got United Health up about 3.75%. I'll close here with the transports. Didn't do that well today. A lot of these names have been seesawing between bullish and extreme bearish territory over the last few weeks, but we'll call this a net loss for the day for a lot of these issues. Nevertheless, Uber finishing the day up about 2%. Back to you, Josh.
All right, Jared, thank you. Let's turn now to earnings, because Salesforce is just out with its Q4 results. Numbers just crossing the wire here. You can see the initial reaction. We are in the red. Q4 adjusted EPS, 381. Street was closer to 305. Q4 revenue, 11.2 billion. Estimates were 11.17 billion. Q4 remaining performance obligations, those come in at 72.4 billion. The street was closer to 71.3 billion. Importantly, what do they see ahead? For Q1 revenue, Salesforce is giving you a range here of between 11.03 billion to 11.08 billion. Estimates were closer to 10.99 billion. Capital return news as well. Salesforce does increase its share buyback authorization to $50 billion. Just looking commentary from the C-suite, Mark Benioff chair and CEO of Salesforce, saying here, we've rebuilt Salesforce, he says, to become the operating system for the agentic enterprise, bringing humans and agents together on one trusted platform. Remember, in terms of AI disruption efforts, a theme we've talked a lot about here on this program, really Salesforce has been front and center. The stock down hard. Heading into this print, it was down about 30% this year. It was down about 40% over the past 12 months. So plenty of skeptics about what this great AI trade and trend is going to mean for Salesforce. I know some are also watching what the company is going to say about executive departures at Salesforce, some leaving for AI companies and startups. What does that mean? What does that imply, if anything? On the other hand, there are plenty of bulls too. They think these AI fears are now baked in here. They're very focused on the number of paying Agentforce customers. That is the company's AI product. That is your window into AI monetization efforts at CRM. How the street feels about this name. Broadly, we should point out analysts see opportunity here. Nearly 80% of analysts think this name is a buy, including Brent Till over at Jefferies, friend of the show. In his preview, he told his clients CRM is an opportunity. He said he thinks Mark Benioff's company can reach double-digit growth in the long term, driven in part, he does talk about Agentforce monetization. Conference call here for Salesforce. That's going to start at 5 p.m. Eastern. Well, for more on Salesforce, let's welcome in now more insights and strategy CEO and chief analyst. That would be Patrick Moorhead, along with Yahoo Finance's very own tech editor Dan Howley. Patrick, great to see you. We'll start with you, Patrick. Your instant reaction to the print, Patrick. What do you make of the results?
Josh, thanks for having me on the show. It was a pretty good quarter, right? I mean, you had a beat on the top line and the bottom line, albeit small, and the guide was decent as well. But I think anything that wasn't a 25% improvement or adder, I think you were going to get this after hours results like we're seeing right now. And the question is, what gets discussed on the call, and where does it hit tomorrow?
I mentioned, Patrick, and we should say, revenue is going to be about $46 billion in the fiscal year ending in January 2027. Per Bloomberg, that forecast it's in line with what analysts had penciled in. But clearly, just initially here, it's not impressing folks in the after hours. I mentioned, Patrick, how heading into this print, this stock has just been clobbered. I mean, it was down 40%, Patrick, in the past 12 months. These AI disruption fears are just front and center for Mark Benioff's company. Do you look at that reaction, Patrick, and say, you know what, that's fair, that's reasonable, or do you think, you know what, that's overblown? I'm just curious to get your take.
Yeah, I feel like this, we're in this DeepSeek moment, right? And this is just the new version of it, SaaSpocalypse. And it's never as bad as you think it is, and things are never as good as you think it is. So we're trying to find out what is the reality. And there are certain companies and certain sectors that are going to get gutted, right? And those are that don't sit on a crop of data that is hard to get to and hard to integrate. The data and the applications that people rely on from a day-to-day basis. And if I measure up Salesforce against that, they've been one of the first movers on AI, and then with Gen AI and agents, they flexed their pricing model. That doesn't mean that there's zero risk. There is, but it is a competition between horizontal agents that are retrofitted into adding value into their use cases versus the easy button. And I think that where we're going to end up is, could be a split. I mean, some companies are not trying to innovate in the front end of the business and will probably gladly pay Salesforce the incremental money for the AI. There are those who it is their core competency, and they're going to try to roll it themselves and likely dial down Salesforce.
What do you say, Patrick? I want to bring Dan in here as well, but a quick question, Patrick, to you is, what do you say to those investors who say this technology, right, this AI paradigm shift, it's moving so quickly, Patrick, that I just don't want to touch any of them. Just whether it's Salesforce, Adobe, ServiceNow, take your pick, because they feel, Patrick, like they commit capital, they go to bed, they think everything is okay while they're sleeping. Sam Altman, right, decides he's going, he throws a bomb, decides he's going into your vertical. You wake up and you've been shelled. It's like you're in a biotech company, Patrick. You put money to work in a company, you go to sleep and a rat dies in Norway in some lab experiment. You wake up, you've been shelled. And so they think to themselves, really, you know what? I don't need any of this. I'm just going to move into a name I think is more AI resilient. I'm going to move into Exxon. I'll go to Walmart. McDonald's sounds great. What do you say to that?
Well, I mean, your paybacks aren't going to be great. Your risk goes down. It's not nearly as appreciative as you could have been. I think it's a little misaligned. I think even the reasonable investor should be looking at this and saying, fundamentally, what's an area that is a no miss? And quite frankly, the market's very contradictory. You can't be crushing it in infrastructure with the Nvidias and the Broadcoms, and then not be buying them up if you think it's going to displace enterprise SaaS, right? You have to pick a thesis, a conservative thesis, somewhere in between, the Citrini blog that came out and some other, and you have to pick your poison. I don't think in any of the scenarios that we're running that infrastructure is a lot of risk. In fact, the only risk to infrastructure is we don't have enough power in 2028 to light up the data centers.
Dan, my friend, you've been waiting patiently. Get your take as well. Again, Dan, this was a stock. We were down 30% this year already heading to this print, at least initially. It seems like we're a bit disappointing after hours. You're down about 2.5%. We'll wait for the call. But your thoughts, Dan, on the print?
Yeah, I mean, look, 27% year to date, 37% over the last 12 months. There's just two things that I want to point out real quick, and that's that, obviously the revenue growth slowing over the past several quarters from the 20% range down into the single digit range. That kind of bounced back a little bit this quarter. The year-over-year growth was up to 12%. So you would think that the reaction would be a little bit better than what you're seeing right now, or I guess this is the better than it could have been considering 37% over the last year. I also want to point out that Mark Benioff had said that Agentforce, which is their kind of integrated AI that they have, the annual run rate for that is now at $800 million. So that's up 169% year over year. And so far, they've closed 29,000 deals for Agentforce. They say that's up 50% quarter over quarter. And so, they're making moves with AI. And, as Patrick was talking about, this big discussion of does Anthropic, does OpenAI, do they kind of become the death knell for these software companies? You have to decide where you kind of land there. And my thinking, and from folks that I've spoken to, is that this will be just another kind of tool in their tool chest when it comes to what they can offer their customers down the line. And you've seen Salesforce make deals with Anthropic already, so it's not as though they're unaware of what's happening at all times. They've certainly said that they're working with them. We saw Anthropic make some deals with their announcement yesterday with their new launches for plugins and customized plugins for Cowork. So the idea that this is just kind of going to completely level all of software feels a little far-fetched.
Final question, Patrick, to you. There's some smart guys on the street. They're bullish on this name. They tell their clients it's a buy because, in part, they believe, listen, in the quarters ahead, yes, you're going to see some real meaningful Agentforce monetization, Mark Benioff's AI product. Do you share that confidence, Patrick? Would you be more cautiously optimistic? You're skeptical? Give me your thoughts.
Yeah, at this point, I'd be a little bit more cautious on that. The Agentforce momentum is absolutely stunning and impressive, but when I match up that $800 million to what enterprises are investing into agents that can potentially replicate certain functionalities, but not all, I want to do more of my own research, meeting, and we do a lot of CIO advisory councils. I want to dig into this one to see where they are in the next 6 months. What I do know from meeting with a lot of them is they are very much building their own agents to replicate and replace a lot of the enterprise software without there. And I'd like to end with the fact that this is very difficult. A large company with technical debt and the interfaces into the systems of record and into systems of transaction, you are not going to open claw this, folks. Okay, this is a very, very high risk type of thing, and there will be some rabbits. And I'm quite frankly, I'm expecting there to be some very public mistakes that people make trying to displace software from companies like Salesforce or Workday or even SAP.
Patrick, Dan, don't go anywhere, fellas. We have a lot more earnings straight ahead. Coming up, we get Nvidia's earnings. That's next. Don't go anywhere. We're awaiting Nvidia's earnings. Joining me now, we got Angelo Zeno, CFRA Research Senior Vice President and Equity Analyst, and Patrick Moorhead, More Insights and Strategy Founder, CEO, and Chief Analyst. Angelo, I'll start with you as we wait for these results to cross the wires. What are you expecting to hear, Angelo? What are you looking for? What are the metrics, the data points you're going to make a beeline for?
Yeah, I mean, listen, Josh, I think, clearly everyone's going to be looking at the top line here, and you kind of look at the numbers. You're looking at, about 66 billion or so here, 66, 67 billion for the January quarter, about 72 billion plus for the April quarter. You're going to have to beat by at least 1 to 2 billion on both sides of things. Driven by the strength on the data center side of things. That's really the key. I think all eyes are going to be on what the demand trajectory looks like, what Jensen has to say about kind of the sustainability of demand as we go through the year. We know the quarter is going to be good because we've just seen all these CapEx, all the CapEx boosts from all the massive hyperscalers out there. So I think really that's going to be the key is, what that trajectory looks like, what Jensen has to say about it. Clearly, there are a number of storylines, whether it be China, whether it be, the memory pricing environment, what that has to do as far as the AI server demand goes. But most importantly is going to be that demand trajectory.
Patrick, bring you in here as well. I'm curious what you're looking for, Patrick. You would expect good results, no? Just given what we've heard, Patrick, from Taiwan Semi, from the hyperscalers. Yeah,
so the beat's already built in on how they're doing now. So the guide is going to be everything, and everything I'm seeing in the channel going all the way through Taiwan and China is absolutely game on. So the real question is, can they hit a $75 billion forecast to impress everybody? I think anything short of that will be looked at as a disappointment, and then everybody's going to want to know about specifics about Blackwell, right? The mix of rack scale systems, board, the pace of deployments. What is the gating factor here? Power and data center build out. So, aside from a home run number, people are going to want to just understand details and specificity to give them confidence in the entire year. And I think it was discussed, the most important thing is how does that $650 billion of AI infrastructure spend translate to NVIDIA goodness, and what do they need to get there, and what's the pace of them to get there?
Angelo, heading into this print, curious to get your thoughts about this. If you pull up a chart here, Angelo, you look at the last 6 months, NVIDIA's done basically nothing. And I'm curious what you make of that, Angelo. What explains that? I've heard different theories. I've heard, investors maybe are kind of thinking through a shifting, broader competitive market for NVIDIA. Others saying, it's just that the good news for 2026 is baked in, so Jensen better start giving us some hints about 2027. But what do you make of that?
Yeah, no, I think there's a little bit of all of that in there, but you kind of think about just how semi cycles work as you kind of now get longer in the tooth in this cycle. You look at that CapEx boost that we just saw in Q4 across the board. Alphabet really kind of raised the bar, essentially wiping out all the free cash flow generation this year that's going to go towards that CapEx spend. And then Amazon obviously had to do it. Microsoft's probably going to spend more than the street is is forecasting at this point in time. And we know what Meta has done. And that really does, it increases the, obviously the upside potential here for NVIDIA in the near term, but it also increases the risk for NVIDIA and the sustainability of demand. There are things that can kind of come into play that causes them to potentially miss numbers in the future, or causes a potential setback in terms of the spend. So I think there is increased risk from the jacked up spend that we're seeing here in the near term. I do expect it to be sustained this year and through next year as well. But that said, I think you do have to compress the multiples a little bit on that greater risk that's out there. That doesn't necessarily mean that the trade is over or the AI landscape is deteriorating at all. But I do think that the risk has increased, and I do think you're now kind of getting longer in the tooth here. And I think investors are just kind of compressing the multiples a little bit. But that said, we still like the environment here for NVIDIA and the broader AI ecosystem.
Patrick, I want to get your take on the competition as well.
Yeah.
And how, Patrick, you think competition has evolved for NVIDIA over, say, the past 12 months, and what you see ahead?
I mean, 2 years ago, if it wasn't an NVIDIA GPU, then I think the meme was basically that it doesn't compete, and it won't compete, and you should just exit the market. And then subsequently, we've had AMD come in, and while the Google TPU was around for a long time as delivered by Broadcom, it really didn't do what I would say as hit. Trainium had volumes, but not a lot. You had Meta MTIA that really wasn't changing the game. And then you had Google with TPU, and it was mostly about Gemini 3.0, where people really stood back and thought, oh my gosh, this could really be competitive. And not only were all the Gemini models trained on TPU, but also you have the inference being done as well. So that does open up there is competition here. And Josh, I've been on your show multiple times saying that this was going to happen, and it happened. And here we have AMD with where they get more architecturally competitive with NVIDIA. Essentially, AMD was trying to compete with NVIDIA's higher end architecture. It's technically a scale-up architecture versus a scale-up architecture. And NVIDIA, had a 2-generation lead. And now that you have AMD bringing out these big deals with OpenAI and recently with Meta this week, people now see that, AMD might actually be a serious player here. So, the notion, even the notion of NVIDIA having real competition has become a reality. Now, AMD's got a ship. Google and Broadcom have shown that they can ship, but that is, as to the discussion we've had, is a viewed risk out there, and I think is weighing on the stock.
Patrick, Angelo, stick around, guys. Coming up, we will get NVIDIA's earnings. That's coming up next. Don't go anywhere. Hello and welcome to Asking for a Trend. NVIDIA fourth quarter earnings just now crossing the wire, and Yahoo Finance's Dan Howley has all the numbers. Dan.
Yeah, Josh, big beat on the top and bottom line for NVIDIA here in Q4. They posted revenue of $68.1 billion, EPS of $1.62. The estimate was for $1.53 and 65.8 billion in revenue. It's a big jump over last year's numbers as well, when they posted EPS of 89 cents and revenue of $39.3 billion. But I think what Wall Street is reacting to here, as you can see, shares higher, is the outlook for Q1. They're anticipating 76.44 billion and 79.56 billion, somewhere in the middle there. Wall Street's estimates for 72.8 billion, so going higher than Wall Street's guidance anticipations. But when we look at the data center business, that's obviously their crown jewel, that brought in 62.3 billion for the period. The projections there were for 60.2 billion. Now, it's important to note that once again, according to CFO Colette Kress, hyperscalers had a little bit over 50% of that revenue. So those are the likes of Microsoft, Meta, Amazon, Google. We all know that they have $650 billion worth of AI spending coming this year. Obviously, a lot of that will be going to NVIDIA, as well as AMD as far as Meta goes with their announcement just yesterday. One more thing I want to point out real quick. It's a little part of their business now, but it's gaming. That came in just shy of estimates of $4 billion. And obviously that's just been kind of up and down. It's very seasonal when it comes to that category. And when they're going to come out with new cards, they haven't done that in the most recent year as they did it last CES in 2025. But a big beat for Nvidia here. And that's really, I think, what they needed as far as the stock price goes.
All right. Thank you, Dan. Let's get to more reaction from NVIDIA's fourth quarter earnings results. From me now, we got Angelo Zeno, Senior Vice President and Equity Analyst at CFRA, and Patrick Moorhead, More Insights and Strategy Founder, CEO, and Chief Analyst. Guys, welcome both. Patrick, I will start with you. This forecast, Patrick, I mean, they're calling for Q1 sales, they say. They're going to be about $78 billion. The consensus on Wall Street was more like $72.8 billion, so blows past consensus. What do you make of the report, the guide, Patrick?
Yeah, Josh, they crushed the guide, they crushed consensus, and they crushed the whisper number, which I had mentioned was $75 billion. So I'm actually surprised the stock's not up even more today. And it's clearly that demand is not an issue. It's the question. The demand is there. The question is how much, how quickly can they get this out? And I think what they proved is even for some of the more optimistic investors, they blew that away.
Angelo, bring you in here as well, because I know you tell your clients this isn't just a buy, it's a strong buy, Angelo. That's what you tell them. So your take on the print.
Yeah, I mean, I think Patrick laid it out, perfectly well. They crushed the numbers. The quarter, the guidance was great, and I think what I also noted, it essentially includes no China revenue in terms of the guidance. So again, I mean, I view this as fairly conservative guidance, if you can say that, despite the strong beat. So overall, I think it was great. You look at the margin numbers, mid-70s, which was what they had guided to for the January quarter, again, what they're guiding to again in the April quarter. So overall, I mean, they're executing very well, top line, on the margins and the bottom line.
Patrick, as investors, you're going to make a beeline for that data center business, which they just crushed. I mean, 62.3 versus an estimate. The consensus was more like 60.36. How do you see that business evolving from here, Patrick? What do growth and margins look like?
I mean, Josh, glass half full and optimist is that AI is going to take over everything. And the only question is how much power we can get to our data centers to 2028 and beyond, right? And we already talked about the competitive angle here. The reality is we're sold out until the end of 2027, pretty much everywhere. So the 650 billion capex seems strong. Yes, they are getting into debt. Two of the hyperscalers will be negative cash flow, and people can either be concerned about that or they can view it as a once in a multi-decade opportunity to get the jump on their competitors and get into new markets that nobody thought about. The reason that SaaS is melting right now is there's a belief that the hyperscalers plus the model makers are going to be able to essentially create agents to replace SaaS. And if that's your thesis, you should be running into folks like Nvidia and Broadcom, AMD, companies like that, because they have the ability to get even bigger, even sooner. And the only challenge right now is high bandwidth memory, short term. Packaging is running into red lines. And then, like I said, power in 2028.
Angelo, NVIDIA does say here the guide does not assume any China data center compute. I'm just curious, Angelo, ultimately, what do you think the opportunity is for NVIDIA in China? What does that market look like for them?
I mean, it depends on what they're allowed to kind of sell into there, what the Chinese government allows on their end, and what the U.S. government allows on its end, right? I mean, you look at what AMD guided to. I mean, I think for Q1 they guided to only about 100 million. They had about 300 million or 90 million or so in Q4. So, I think overall, both in Nvidia and AMD very cautious about the China landscape. I mean, ultimately, they should be able to easily pump out 5 billion plus a quarter in China. But again, it's one of those situations right now where you just don't know what the landscape is going to look like because of the geopolitical uncertainties from both sides. So it's really difficult, if not impossible, to really say what the potential is there, because at this point in time, we just don't know what is ultimately going to be allowed to be sold out there.
Angela, how should I think as an investor about valuation for this name? Nvidia trading here, it looks like at about 42 times forward earnings per Bloomberg.
I mean, what we did going into the print was, we've essentially got a 25 multiple on our 27 EPS estimate to get a 250 number. Now, clearly the numbers on our end, as well as the street, is going to go up after this print for both 26 and 27. So I would anticipate that there's potential upside there. But when you look historically where the stock trades, 25 is the low end of their historical range. So I'd say, given where the stock was trading kind of going into the print, about 19, 20 times next year's, we do see potential for upside here for the shares over the next 12 months, and notably so. To Patrick's very good point, Angelo, are you surprised, given this print and this guide, the stock is even higher here in the after hours? It's tough. I think right now, I think there are a lot of investors out there that really want to see the AI monetization side of things. They want to see those, they want to see the enterprise AI tools really start to ramp, and they want to see, I think it's really become a show me story, not necessarily on what Nvidia can show in terms of sales and orders, backlog. I think it's more along the lines of what you can see in true end demand and how that ramps up here over the next couple of quarters into 2027. So I think this is one of those situations where investors are probably going to remain very skeptical on Nvidia and this kind of broader AI infrastructure theme, and it'll be just a grind higher as you can continue to see, let's call it new use cases start to get unlocked on the AI side of things. Patrick, final question to you. Let's say you're on the conference call, Patrick. Jensen and Colette, they come to you. You got the chance to ask them a question or two. What would be top of mind, Patrick?
I think top of mind for me would be HBM, the memory strategy. I mean, they're top of the heap for wafers. They're top of the heap for memory, along with companies like Broadcom. And the question is, what could they do to ramp it even quicker? Right. And to the earlier conversation about downstream impacts, I think that Nvidia, of any company, would have really good insights into that. We obviously track that, and we're seeing activity, but that activity needs to turn into increased revenue for the end users, decreased costs. We're seeing layoffs and things like that, and AI being used. But I think really going down that end user impact type of conversation. I mean, I think the stock, I differ a little bit as kind of what's going on right now. I think it is the overall risk of, and not necessarily the downstream impact, but it's what's going to happen next competitively. Where's the power? I'm sitting in these conferences and discussions with these hyperscalers, and there are concerns about bringing it together at this velocity. We went from a 3-year new product and then a rolling into the data center, the hyperscaler data center. Maybe they would take it, maybe they wouldn't, to 2 years to 1 year. And that is an execution nightmare. I'm surprised with these numbers where they are.
Patrick, Angelo, thank you both for that instant analysis, guys. Appreciate it.
Thank you.
Thanks.
Stick around. Much more Ask for a Trend. That's still to come. The IPO market off to a strong start in 2026 with 11 venture or seed-backed U.S. companies going public and raising over $3 billion, just over the amount raised in the same period last year. That's according to Crunchbase data. Our next guest scored the outlook for IPOs this year, saying 2026 is on track to earn a silver medal But if we get some of those mega debuts like SpaceX, Anthropic, or OpenAI, it could earn the gold. Joining me now, we've got Dean Quiambo, Armanino partner and technology industry leader. Dean, always great to see you. So you do say here, Dean, it's potentially a silver, maybe even a gold for the IPO market if the mega deals do land. So what has changed from last year, which you say it was more like a bronze last year? So break that down. What's changed? What's shifted?
Yeah, the big shift is the mega IPO could be back. That's what everybody wants to see. OpenAI, Anthropic, SpaceX, Databricks, the really, really large companies, the one that make the huge impact. It's almost like the recent Olympics in Milan, when we see the US win figure skating for the first time in 22 years, or women's hockey or men's hockey for the first time in 46 years. It just hits different. When you have that mega IPO happen, that hits different as well.
What if the mega name goes public though, Dean, and it disappoints? You know, maybe it's priced too aggressively, right? You see a big drop, you see a 20% drop. What would that then mean for the IPO market?
I think the IPO market is still going to remain strong. It's still going to remain good. And the reason I say that is because of all the conversations we're having. We're seeing so many companies in the technology industry building. They're building with people, process, and technology. They're hiring firms like mine, Armanino, to help them down that IPO journey. And we're seeing it in many, many places. That's why we're saying that the IPO pipeline is very strong.
You talk here, Dean, about the volatility in public software stocks because of all this AI disruption. If public comps make these kind of wild moves, Dean, what does that mean for the IPO? What are some ripple effects there? Do you think bankers maybe, is it possible that they get more cautious because of that, Dean?
No, I think it's more of a speed bump and just a recalibration. I don't think this is a big pullback. I think it's a calibration of what's going to happen. Broader economic data is still going to move everything in a positive direction. And I think that the IPO market will also move in that positive direction. Things have just been building for quite a while.
You say here, Dean, AI native economics. They're structurally different, you argue, from legacy SaaS names. So that's interesting. How so? And if that's true, Dean, then okay, what are the data points? What are the metrics, as a public market investor I should be focused on there?
Yeah, that's a really good question. When you start to see the valuation of these new AI companies, when you start to see the revenue per employee and how fast they're moving, how they are layering in automation because they are AI native, it's different. And I think you're going to see a difference in the speed of growth of these organizations versus the more traditional legacy companies. They're operating different. And I will tell you that we saw the legacy companies kind of hold off on IPO. The new AI native companies, their goal is IPO. They are moving to that. They want to get to the public markets. They want to get out there, and they're building and scaling and hiring accordingly.
You highlight how AI companies, they are scaling revenue at just kind of unprecedented speed here, Dean. Quantify that for us if you could. And do you look at those economics and say, yes, that's sustainable?
Yeah, absolutely. Well, it's we talk about it here, right? What is the new trend? And there are new trends in adoption of AI, and these companies are helping to that adoption of AI. And that's why there's so many organizations, people, leaders, companies that are swimming towards that. I think this time last year, if you said, okay, how many leaders are using AI? It would have been like, I'm trying to, I don't know how. Versus where we are today. And now I talk to hundreds, if not, I was in a room the other day with 1,000 leaders, and they were actually using AI in their business processes, and it was making a difference. Last year, they talked about it. This year, they're doing it. That, and you start to spread that over lots of organizations. That is where this growth is coming from, right? Everybody wants the efficiency growth. They want to show the revenue moving, the margin moving, and this is all helping it.
You say there's a backlog of enterprise SaaS companies, Dean, waiting to go public. They're waiting in the wings here. I guess, though, Dean, if AI native names come first, let's say they go first, they make their public market debut, they have a positive, strong reception. Do those other companies I don't know. Do they get squeezed out, Dean?
Yeah, it's almost like the NFL Combine is happening here this weekend, Josh, and you always have a wonder, like, did somebody stay in school too long, and maybe an upstart is coming up behind them. That challenge could happen, right? Because these native AI organizations are growing so fast, they're taking on market share so fast. Does that start to happen? I think that's another reason why we'll see 26 as a strong year for IPOs, because folks want to get out to market.
Dean, as always, great to have you on the show. Thank you.
Thank you.
Time now for what to watch Thursday, February 26th. Investors gearing up for a busy Thursday. We're getting some more tech earnings with Dell, CoreWeave, and Zscaler. In the media space, Warner Bros. Discovery is reporting fourth quarter results, but the numbers may take a backseat to the takeover drama, of course. Paramount Skydance raising its all-cash bid to $31 per share, topping its prior offer and stirring up competition with Netflix. The board says it's reviewing the revised offer while its agreement with Netflix remains in place. Beyond the M&A fight, investors will be watching advertising trends, the absence of NBA programming likely pressuring fourth quarter results. On the software side, Intuit reporting Q2 earnings. That stock mounting a comeback after getting hammered in the recent software sell-off. Analysts looking for about 14% revenue growth in the quarter, driven by strength in its global business solutions unit, including QuickBooks. Investors will listen closely for commentary on tax season momentum and how its AI-powered tools are contributing to growth. On the macro front, Fed Vice Chair for Supervision Michelle Bowman is speaking on Thursday. This coming after comments from Richmond Fed President Tom Barkin. Barkin telling Yahoo Finance on Wednesday that he's hopeful inflation will cool, but warned that consumers are feeling exhausted by continuing price increases. And finally, new initial jobless claims data. That's coming on Thursday. Economists forecasting claims to rise slightly to 216,000, up from 206,000 the week prior, giving us more insight into the health of that labor market. That's a wrap on today's Ask for a Trend. Thanks for watching.